So I make $30,000 every single month doing this exact option trading strategy that I'm going to teach you in this video right here. Yes, it's literally $30,000 or almost $1,000 per day. It's pretty crazy. It didn't always start out like this. So this is a screenshot of my portfolio. You can see I crossed over $1 million just a couple weeks ago. There has been a lot of volatility since then, so it is bouncing above and below this number right here. But I'm just showing you this because anybody can do the strategy that I'm going to show you right now. And I feel like I found one of the best ones that works consistently in a bull market and a bear market that I use every single month to capitalize. This is essentially the strategy that retired me. So when I started out and did my first options trade, I made $30 on my first trade, and right now I'm making roughly $30,000 per month on average. But when I started out, I was like, if I can make 30 a month, why can't I make 300, then 3,000, then 30,000? And then if I make 30,000 right now, why can't I then make $50,000 to $100,000 per month? I knew that if I could get a good strategy that would scale in a bull market and a bear market in a low risk way, it's going to scale as my portfolio scales. So when I started out, I focused so much time and energy on learning all the strategies of the stock market and how the stock market actually worked. Because a lot of people are going to say the stock options are about stock options, but they're not at all. So just stick with me here for a minute. Stock options are about what the underlying stock is going to do that you do options on. So just look at this chart right here of Triple Q. So Triple Q tracks the NASDAQ, and you can see in 2022 we had this big dip right here because interest rates went up and inflation went up. So the Fed raised interest rates to try to bring inflation down. But the market doesn't like when interest rates go high, but I knew that this was opportunity. So imagine if you wanted to buy a call option on Triple Q in this time frame right here, and you decided to do it literally right here. If you would have bought a call with maybe like a 6-month duration, you would have got smoked right here. But if you would have bought a call when you knew when the market was going to be close to bottoming, you would have made a crap ton of money on it. So I'm going to show you in this video some of the key things I look at to know when the top or the bottom of the market is. But the point that I'm trying to get at is you have to understand if the market's going to go up or down, or the stock, whatever you do this on, and then you make an options trade based on that to try to capitalize on a move that you are expecting to come. If you don't know if a stock's going to go up or down, how can you go do options on that stock right there? You're going to lose money, so you have to know what is the direction of the stock, how do I do an option trade to capitalize on that? So when I do options, I only want to pick the highest quality companies. I don't do it on penny stocks. I do it on big blue chip companies or ETFs to track the S&P 500 or the NASDAQ because it's consistent cash flow that you can make money every single month in your account, whether the market's going up or down. You could still make a crap ton of money doing this. So when do you enter, like I said before, and when do you exit? You want to know when the market's going to go up and when the market's going to go down, and then you put your plays in based on that to capitalize. So now we're going to go into the 3 charts that will show you with high confidence if the stock market's going to go up or down. And I get it that these charts are only going to be for the stock market as a whole, like the S&P 500, but if you can understand what the S&P 500 is going to do, you could get a good idea of what the overall market's going to do and all the stocks within the S&P 500, because it's kind of like a boat in the ocean. When the tide comes up, everything goes up, and when the tide goes out, everything goes out. So that's usually how stocks go. So going into chart number 1 out of the 3 total, this is showing you the forward PE ratio for the Mag 8 stocks going forward, for the S&P 500 and the small cap stuff right here. So you could see that historically speaking, our PE ratios are a little bit expensive in this whole time frame right here. This chart goes all the way back to 2000, and you can see right now our forward PE ratio on the S&P is 21.5, so we're a little bit expensive. Now you can see there's a little bit of a dip right here on the side of my cursor. That's when the market recently took a dip down. So when it dipped down, it technically got a little bit cheaper, so it's a little bit more compelling to make a trade. But this chart only shows you a little picture of everything. We got to go into the other 2 charts, but just generally looking right here, the stock market does appear to be a little bit overvalued because the forward price earnings ratio is one of the best ways to get a snapshot of the valuation of something as super expensive or super cheap. Now going into chart number 2, this is one of the most important ones. This line right here that I'm highlighting, the less jaggedy line, this is the earnings growth on a forward basis of the S&P 500. And then the jaggedy line, the lighter line right here, this is the actual S&P 500 index. So in the long run, typically speaking, the S&P 500 will follow what the earnings growth of these companies do. So if the earnings growth goes from here to here, typically the stock market is going to follow that from here to here too. And I know this seems very, very basic to look at it like this, but it actually works out. If you really go to anything on like a 10 to 20 year time period, it should follow pretty close to what the earnings do. Apple or Nvidia, all those companies, if you plot what the earnings did of those companies and then you plot what the stock chart did, you will see NVIDIA where the earnings went way up and the stock chart went way up with it. So the S&P 500, you could see right now, it is a little bit disconnected from the earnings. So right here, it's indicating that maybe the market is a little bit overvalued. Now, a lot of people are making arguments that the market is not overvalued because of AI and the tech revolution that's happening right now. A lot of the earnings are kind of like artificially suppressed right now because all these big companies are investing into their AI data centers, which it is very expensive. And of course, NVIDIA is one of the top companies that makes a crap ton of money when that happens. So think about it. Google, Amazon, Tesla, Meta, all these companies are investing into their data centers super heavily right now. So that's making more expenses for the companies. So that's actually pushing earnings per share down. So that's why right here, there's not really much earnings growth. You can see there's a little dip right here. And I think that has a lot to do with all these companies investing so heavily into their AI data centers. But here's the thing about it. If AI pans out to be as transformational as what everybody is saying, this earnings could go way up and it could catch up to what the actual S&P 500 did. But if it doesn't, we would expect the S&P 500 to correct lower down to this earnings line right here. Now you can see the S&P right here is roughly 5,800, but if it corrects down to what the line right here of earnings growth is, we could go all the way down to 5,100. So that is roughly a 10 to 20% drop of the S&P 500. Now also look at the reverse right here. This is when the Fed was raising interest rates and the stock market came down. You could see the earnings came down a little bit too, but the stock market overreacted and actually went down a lot more than what the earnings growth did. So right here, I talk about it like a rubber band being stretched down. So you can see the S&P is down quite a bit in this time period right here. So the more that you stretch it below the earnings growth line of the S&P 500, which is this line right here, the more that it wants to rebound and go up. So it was stretched down pretty hard right here, and then bang, it was pretty much straight up from that time period right there. So looking at charts like this, you could get a very general consensus of, is the market overvalued or undervalued? So is now the time to go YOLO calls on expensive companies like Palantir or something like that? I think the answer is no to that. But there are companies right now that I feel like are trading below intrinsic value. And after we go into chart number 3, I'm going to show you into my $1 million account to show you a couple trades that I have open right now that maybe you can make too if you want. So this is chart number 3 right here, which is interest rates. After we go through this chart, I'm going to show you the exact strategy of how you could capitalize and then a trade that I just did to show you how I'm actually doing it. So interest rates are like gravity on the stock market. If interest rates go way up in this time period right here, stock market valuations are going to come down because just look at it. Interest rates were up here almost at 20%. So bond yields were almost at like 15 to 20% in this time period right here. So if you could get a guaranteed rate of return of 15 to 20% in a bond, which was in 1980, or you could risk it in the stock market and maybe get 10% on your money, which one is going to be more compelling? The guaranteed 15 to 20% or the risky 10%? So in this period right here, stocks were not attractive and price earnings ratios on the stock market were very, very low. You can see right now price earnings ratios were right here around 21.5, but in this time period right here, price earnings ratios were below 10. So basically what that means is if interest rates were to go to 20%, which I don't think they're going to do, but if they would, price earnings ratios on the S&P 500 would go from 21 to below 10, so that would indicate a 50% stock market drop. I don't think that's going to happen, obviously, but that just shows you the relationship between interest rates and what the stock market could do on a valuation level. So now the strategy, and before you click off of it, because I know you might think it's a boring strategy, let me show you how I do the strategy and why I do it, and then show you the trade, because I guarantee you it's going to change your mind about doing other strategies going forward. So I like to sell puts, and if the puts that I sell go in the money, I will then roll them lower because it just gives you more time for the trade to play out how you think. So the stock that I do the puts on, the stock has to be trading below intrinsic value. So intrinsic value is just essentially what is the stock actually worth. They have to have a moat. They have to have pricing power. So companies like Apple or NVIDIA, where it's like NVIDIA really doesn't have much competition. Apple doesn't have much competition. I know we could get into this growth argument with Apple where it's like they're not innovating anymore, but it's like most people have iPhones, and iPhones really are like, if you have an iPhone, you're never going to go to an Android. That is a moat. That is pricing power. If Apple raises the prices on a cell phone to maybe $500 more, honestly, most people are probably going to buy them still. You want to have a durable competitive advantage too. So Warren Buffett was one that pushes durable competitive advantage a lot, and he basically told Bill Gates, like when computers were coming out, Bill was trying to push computers on Warren Buffett and kind of like invest in a hot thing, and Warren was like, well, are computers going to change if people chew gum? And Bill Gates was kind of like, no, it has nothing to do with that. So Warren Buffett was like, that's fine. You could go invest in computers. I'm going to invest in Wrigley's, which is a company that makes chewing gum. So that is showing you that they have a durable competitive advantage, meaning like that market is going to be hard to wipe out. That's also why he has a lot of money in Coca-Cola, because it's like Coca-Cola versus Joe's Cola. Most people are going to go with Coca-Cola. And you also want to be okay to hold the stock for the long run. You don't want to go sell a put on something and then you're not okay to hold it for the long run. If you meet this whole criteria right here, you could make a crap ton of money selling puts. Now, super quick, and then we'll go into my $1 million account. So this is a chart right here of the NASDAQ, and you can see right here in 2022, as we talked about before, the market was dipping. But when the market was dipping, I knew that this was opportunity and the market was cheap. And I knew that inflation was going to eventually go down, which means the Fed could lower interest rates, which then means the stock market could go up right here. So the $1 million account was roughly worth like $300,000 in this time period right here. But I positioned myself to capitalize on this dip, and I went from $300K to over $1 million in the Charles Schwab account in this time period right here. I get it that the market's bouncing around like crazy right now and it's going above and below $1 million, but eventually that account is going to stay above $1 million. But that's just a massive move that I capitalized on right here with my strategy of selling puts when things are trading below intrinsic value. So now let's go into the $1 million account. I'll show you some of the trades I have open right now and why I did it. So here we go. So this right here is a trade that I just recently made on NVIDIA where I sold the $100 strike price put. So essentially what this means is if NVIDIA falls below $100 per share anytime between now and 6/18 of 2026, I have to go buy the shares for $100 per share. Now, in order for me to do this trade, I got paid $21,000 immediately, which is basically just like a credit to my account for doing this trade. So that $21,000 equates to roughly $14 per share in premium. So technically, if NVIDIA falls to $100 per share, my break even is going to be $100 per share minus $14 per share. So my break even is roughly $86 per share. So now just think about this in general terms. If NVIDIA falls to $86 per share anytime between now and 6/18 of 2026, would you want to buy that? I personally do, because it's going to be super on sale. Most people are going to say, oh, well, that's risky. You're going to have to buy all those shares of NVIDIA. But it's like, I'm okay to buy it right now at $135 per share. Why would I not want to buy it for $86 per share? So this is called selling a put option. And then you can see right here, I bought a call on NVIDIA with this premium. So when you're super bullish on something, you could sell a put, get the premium, and then go use that premium to go buy calls on it. And as long as NVIDIA stays above $100 per share, everything is going to be okay. Now, I'm super bullish on NVIDIA. I went through every single line of the earnings call, the whole earnings report. I know a lot about the company. I went through other companies like Google, Meta, Tesla, all that stuff right there to see if people are still spending money on NVIDIA chips. I went through SMCI and Dell, who implements these chips. I'm a very, very informed investor when it comes to NVIDIA. But when you understand this stuff on a molecular level like that, you will feel confident to shoot out trades like this right here. So like I said, if NVIDIA goes to $86 per share, take my money. I will gladly buy NVIDIA for $86 per share. Now, I think that between now and 6/18 of 2026, I think NVIDIA is going to be much higher than what it is right now. So there's a bunch of other strategies that I do that I really like a lot, but selling puts is one of the best ways to consistently scale your portfolio, get cash flow, and then essentially roll that cash flow into more shares in your portfolio. That's how you build your portfolio super quick. If you want to understand this stuff on a deeper level, click the link below for my course. It's 80% off right now. It's very, very cheap. It's under $100, and I promise you're going to get way, way, way more than $100 worth of value out of that. Then you could come into my course members only Discord and get all the access to my Zoom calls, all my live trades, access to me, all the good stuff. But if you don't want to do that stuff, watch the video right here. It's a little bit deeper into me selling put options. I'll see you guys there.